Ladies and gentlemen, good afternoon to all of you. I am Anandan, Executive Chairman of the company. I welcome you all to the conference call to discuss the company performance for the third quarter and for 9 months ended December 23. I have with me Mr. P. Balaji, Managing Director, Mr. C.P. Manoharan, CEO, and Mr. John Vijayan, CFO. The financial results and the investor presentations are already available on the stock exchange and the company website. I hope you have a chance to look at it. As you know, affordable housing finance as an industry has been backed by several initiatives, including from the government in the form of interest subvention, tax incentives, priority sector status, and lower risk weightage on small ticket of loans. This, coupled with low mortgage penetration and high housing shortage, particularly in the Tier 3, Tier 4 cities of the country, across geographical markets, makes us to believe that there is significant runway for growth in the affordable housing finance space. And we can continue our growth momentum of serving low and middle income customer segments belonging to self-employed category, living largely in Tier 3, Tier 4 cities. Aptus, as you are aware, is grown with due importance in the quality of its loan book with good financial metrics. Very happy to report that Aptus had a good third quarter and 9 months 24. Sharp business focus, good distribution network, deep penetration in served markets, customer centricity along with appropriate tech support have enabled the company to achieve good growth. The company's performance for this period demonstrates a sustained trajectory of stability, growth, and diversified income stream. In order to take the company to the next level of growth, middle management in sales and marketing functions, credit, collections, and IT have been strengthened. I think they mentioned about it in the last concall as well. They have been strengthened in addition to investments in relevant technology. Our net worth stands at over rupees 3,500 crores, indicating robust capital adequacy. This, coupled with good support from NHB, banks, DFI, and other providers of funding, along with robust on-ground demand for both home loans and small business loans, gives us the confidence to pursue strong growth in the years to come with sustained profitability. I will now hand over the line to Mr. P. Balaji, Managing Director, to discuss the business focus, operating and financial parameters. Over to you, Balaji.
Thank you, sir. Good afternoon, friends. As we have been explaining in the earlier calls, we will continue to focus on key strategies, which are growing disbursements and loan book both in housing loan and small business loans, considering the large headroom available in the low and middle income segment in Tier 3 and 4 cities. Increasing penetration in existing geographies by opening new branches and commencing operations contiguously in the states of Odisha and Maharashtra. Strengthen analytics and digital adoption. For this quarter, the business from the tech-enabled platforms was around 17%, and mostly this has come from customer referral app, construction ecosystem app, and social media channels. Our focus shall be to increase the leads through these channels in addition to the physical branch network. Of course, we would like to continue to our focus on productivity, collection efficiency, OPEX, and cost of funds. Major performance highlights for the 9 months are as follows. AUM grew by 28% year-on-year to 8,702 crores. Disbursements increased 25% year-on-year to 2,159 crores. NIM was at 13.37%. OPEX to assets was at 2.67%. PAT at 448 crores has grown by 22% year-on-year ROA and ROE was at 8.06% and 17.1% respectively. Total live customers were 125,000. This has grown 25% year-on-year. During the 9 months FY24, 31 branches were opened, including our first branch in Maharashtra. Now coming to the asset quality, collection efficiencies dropped marginally by 7 basis points to 99.65%, mainly because of unprecedented rains and floods in the southern part of Tamil Nadu during the month of December. Our 30-plus DPD improved by 23 basis points to 6.04% on year-on-year basis. This will be focused and improved upon in the ensuing quarters. Net NPA was at 0.89%. Provision coverage ratio has been maintained consistently at 1.06%. We are carrying a total provision of 86 crores, and this, when computed as a percentage of NPA, works out to a coverage of 89%. And moving over to funding, we have well-diversified borrowing. Of the total borrowing, 63% are from banks, 23% from NHB, 14% from NCDs issued to IFC, mutual funds and securitization. Sufficient on-balance sheet liquidity was there as on 31st March to the extent of 961 crores, including undrawn sanctions of 300 crores from NHB and 310 crores from various other banks. Now, with these remarks, I open the floor for the question and answer section. Thank you.
Thank you very much. We will now begin question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while question queue assembles. And the first question is from the line of Raghav Gar from Ambit Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. I just have one question. Your branch network and your employee base has expanded sequentially. Yet, what we've seen is that the OPEX to assets has come down over this last quarter. Is it that a lot of this expansion was back-ended during the quarter, and hence we'll probably see some of those costs in Q4? Just your thoughts on that would be useful. Thanks.
Regarding the cost, see, it is not that it has been back-ended. It is basically, if you look at the cost, it has not gone down very substantially. It is just 2.71 to 2.67% first. And also, if you look at the salary cost, it has gone down by 1 crore as compared to the last quarter. It is basically because if you look at our disbursement, it is grown by 3%. The employee cost that is directly related to the disbursement-related payments has slightly come down. It is basically that reason. It is not because of any back-ending of any investments that has happened.
Sure, thanks. Sorry, just if I can ask one more question. What is your outlook on spread? You see that your yield has it's basically flat quarter on quarter, but the cost of borrowing has gone up. How much more of an increase should we expect in your cost of borrowings, and what would be the trajectory on the yield front? Yeah, that's all from my side.
Yeah, Raghav. So what has happened? The yields have been flat quarter on quarter because we have because of the product mix that has happened in the disbursements in the quarter of Q3. Basically, out of 767 crores, we have disbursed almost 470 crores of housing loans, which means almost 62% of the housing loan, which is earning a lesser rate of interest as compared to the other products. So that is why the yields were flat. As regards the cost of borrowings, yes, we are not very much affected on the borrowing side on the housing finance because we have been consistently raising funds at around 8.25 to 8.5%. But on the NBFC, because of this RBI circular on the risk weight, it has slightly gone up by 0.25%. We are currently raising it around 9 to 9.15%. So it is basically because of that reason the cost of funds is going up. And this quarter also we will be raising funds in the NBFC at around these rates. So it is likely that another 0.1 or 0.15% borrowing cost increase will be there in this quarter as well. But what will happen is, in this quarter, we will be drawing 300 crores of NHB borrowing. So that will slightly compensate for the increase in the borrowings on the NBFC.
Just to add to what Balaji said, our yield, we have very consciously, there is a lag in the, though we have the pricing power to fully pass on the cost increase to the customers, but nevertheless, we have taken a conservative position and we have increased interest of customers much lower than our cost of funds, and there was some lag effect also. But at the same time, to answer your question in terms of further increased cost, as you are aware, the further increase in our borrowing cost most probably unlikely, given the overall environment, including the budget proposal today in terms of total deficit and things like that, and the expectations that the interest rates are likely to soften a bit as we go along in the next 3 to 6 months. So while we don't really expect any substantial increase in the interest rates going forward, if at all it could come down. But at the same time, since we have a significant part of our portfolio in the fixed, contract, while our loan book is a fixed contract, where the interest costs are likely to come down, going forward over a period of time. So that puts us slightly in a better position going forward.
Sure. And one more question. Sorry. So what I've noticed is that the average ticket size or average loan exposure for you hasn't really increased. Whereas if you look at for some of the other affordable housing finance companies, it has increased quite substantially, or they are pursuing growth in higher ticket size segments. So why is it that we haven't seen any increase? Is it more to do with our or with your strategy to focus on this bottom of the pyramid type of customer, and you are averse to say higher ticket size lending? What is it exactly, or is it that you are going down the risk curve? So the average ticket size is not really changing. I'm just trying to understand what's happening here.
No, we have a very clear business focus of, funding to the largely, self-employed, living in Tier 3, Tier 4 cities, and that too from self-constructed houses is almost about, 80% of our home loans. And again, we don't fund for the land, we only fund for the, construction cost, part of the construction cost. This results in our average loan size is lower, and as we go deeper into the, again from Tier 3 to Tier 4 to even that level deeper into the territories, the average size also will continue, will be somewhat lower. Only if you move towards metro, the loan size will really go up. But we are very conscious in our business focus that, we would want to be really serving this kind of market customers who are really, largely in need of genuine home loans for the genuine, home purposes. So given that, I think, it's not that we're wanting to consciously move towards higher end of the average home loans, because we believe there are a lot of players to really service the higher end, average size, higher loan size. Already we have enough busy players are there, and that is not going to be our focus.
Yes, thank you. I'm done. Thank you.
Yes.
Thank you. The next question is from the line of Nidesh from Investec. Please go ahead.
Thanks for the opportunity, sir. Firstly, on the growth trends, if you can speak about how are the growth trends in terms of disbursement and a loan book in the state of Tamil Nadu, how they are shaping up in Q3.
Yeah, Nidesh. Tamil Nadu loan book has been growing at 13%. There is a slight, there is a 1 quarter lag in the growth which we have actually anticipated in September. But having said that, and also what has happened is, in the last quarter there were floods, and because of that the disbursements in December in Tamil Nadu was slightly low. But when you look at the January disbursements in Tamil Nadu, it has caught up. Basically, the shortfall that has happened in December has been we were able to make it up to an extent in January. Also what has happened is we have got all the manpower in place now, and in Q4 I think the Tamil Nadu growth will be back on track.
Sure. And so I noticed that we have increased our sales manager quite sharply on a 9-month basis. So how is the productivity levels of the now team, and how should we expect growth in FY25?
No, I didn't get your question. Not clear. Yeah, I didn't get your question, Nilesh.
I was saying that we have added a lot of sales manager in 9 months FY24. Our sales manager number has increased quite sharply.
I got your question, Nilesh.
And how should we look at growth in FY25?
See, first of all, let's look at the year ending FY24. What has happened? Yes, we have added sales officers, but we have also added the number of branches. We have almost added 31 branches, and we are also going to add 7 more in this quarter, 3 in Odisha and 4 in Maharashtra. So anticipating this, the recruitment levels have gone up, and we are a productivity-oriented organization. The headcount will increase based on the volumes and also the logins that is getting generated per sales officer per month.
Sure. Yeah. And so lastly, on the yield front, last quarter, I think we have taken 50 basis point price hike on the entire book.
Yes.
But our yields are flat sequentially.
Yes.
That's
what I explained sequentially why the yields are flat, because we did more housing loans in this quarter than the other products, which is actually 15.5% is the yield that is getting in that. So that is why it is happening.
And what is the incremental yield on the loan book? Incremental yield on the disbursements that we have done in Q3?
See, for the housing loan, it is at around 15.5. For the non-housing loan, basically the quasi-home loan, it is around 17.5 to 18%. And for the small business loans, it is around 21.5.
Sure, sir. That's it from my side. Thank you.
Thanks.
Thank you. And the next question is from the line of Mona Ketan from Dolat Capital. Please go ahead.
Yeah, hi sir. Just a few questions. So, firstly on the yield again. So while your yields have held pretty steady, I wanted to understand, because you have raised rates recently by 50 bits across HL and non-HL portfolios. And given the fixed nature of your portfolio, could we see, is there scope for further improvement in yields as we go forward?
No, we don't really foresee any further increase in the yield, at least in the because I think we are quite comfortable in the sense, though we have raised our pricing lower than the actual interest cost, but still, as Balaji said, as the home loans we are at 8.15, and quasi home loans around 17.5, and SMA about 21.5, and weighted average is quite reasonably good. And given the overall context in terms of a possible increase in the interest cost per se, because it is not there, and if at all, interest can only sort of slightly get moderated as we go forward. Given that we don't really see any need for us to really go for any yield increase, further yield increase, we will be quite happy to operate the way. And we will also get the full benefit, because the last yield increase, interest increase was done by us effective 1st of December, 23.
Now, 1st November 22, last one. Last one was in 1st December.
Yeah. So last one was done in 1st December, and the full benefit of also will start accruing for us from now.
Right. So I was not referring to the pricing. I was more referring to the full benefit coming in given the fixed nature of your portfolio. So is that yet to play out over the quarter?
Absolutely. You are right. Sorry, another point. Absolutely. You're right. It's, the full impact will have a beneficial impact for us in the ensuing quarter. Yes.
Got that. Secondly, on the demand environment, I just wanted to understand if there is anything adverse that you're coming across, and how do you see demand for both home loan and SME loans in your segment and geography?
The on-ground demand is quite very strong. I mean, if you look at, after I got into this role, I have also started traveling to branches where I'm able to see quite a good business potential to be done. And if you look at our growth, except Tamil Nadu, if you look at Andhra, it has grown by 47% loan book. And I think Telangana has grown by 41% and Karnataka has grown by almost more than 22%. So when we look at the field, when we look at the demand, that there is no dearth of demand, and it is really good, and we can do more business, and the guided growth of 30% is achieved.
So as you highlighted in the opening remarks, you have strengthened the middle management, sales, credit collections. So with this, do you see scope for higher growth guidance over time?
No, obviously, we are growing on a year-on-year basis. And, in the sense that if we are looking at anything between 25 to 30% of growth going forward. So as it keeps, we are really preparing A for, higher base, and B for higher level of operations. If we are really operating around 10,000 crores today, we are really looking at how can we take it up to 20,000, 25,000 crores going forward. And towards that, we have now started looking at the organization and start strengthening at the second level itself with more resource, basically to prepare the organization for a much higher level of size and growth.
Got that. And just coming to the incremental cost of funds, what rates are we borrowing from banks, both across the HL and the NBFC book? And do you believe cost of funds has peaked, or where do you expect it to peak for you?
I just explained this. On the housing finance company, we have been borrowing at 8.25 to 8.5%. And on the NBFC, we have been borrowing at around 9 to 9.25. Earlier, it was at around 8.75 to 9. Now it is becoming 9 to 9.25 because of this RBI circular on the risk weight. So, but we feel that another 1 quarter after that, we feel that the rates would have got peaked, and we feel the rates can come down in the next year. If that happens, that's what Mr. Anandan also explained. We are slightly better off there because most of the loan book, almost 80% of our loan book, was on a fixed rate basis. So if this, and also consciously what is happening is, we are also moving from the fixed rate borrowing scenario to the variable rate scenario. If you look at our investor presentation, the fixed rate borrowings, which was at around 60% maybe last year, it has come down to 54%. So which means the rate transmission, when it happens, the cost of borrowings can come down. With the result, the NIM can expand.
Also, most of our present, borrowing from the banks, the rates are linked to the, repo rate, external benchmark rate of repo rate, rather than the MCLR. And given that, any change in the repo rate going forward will impact us better, positively.
Got it. I understand your logic of moving more to fixed rate, but doesn't that pose ALM risks in the longer term?
No. You are moving to variable rate.
Sorry, what Balaji said that our loan book is a fixed rate.
Yes.
But the borrowing,
What I told is, loan book is the fixed rate, whereas on the borrowing, from fixed rate, we are moving to variable rate.
Got it.
Yeah.
Got it. And just finally, if you could share the 1+ DPD as well.
8.1.
Thank you. I'll come back in this.
Thank you. The next question is from the line of Kunal Shah from Citigroup. Please go ahead.
Hi. So firstly, on the credit staff, so that has come off. So is there any restructuring or something which has happened on a quarter-on-quarter basis, maybe?
No. What has happened, Kunal, we have reclassified that. Only the branch credit has been shown as the number there, and the head office staff has been grouped under the head office criteria. That's why it has come down. There is no...
Okay, so there's 21 people have moved to head office rather than being classified under the...
They were in head office only, but they were classified under credit, but that's not moved. That's it.
Okay. And secondly, on OPEX, so again, you touch base in terms of it being lower, but eventually how we look at it, because we are seeing many of the HFCs investing quite aggressively, and still from our side in terms of the cost to assets, that's being contained quite well. So do we see that we will have to be in an investment mode quite aggressively to manage this 28-30% kind of growth trajectory, or maybe it can continue at the current levels?
Kunal, we are in investment mode only, but only thing is we don't want to open 100, 200 branches at one point of time. See, what is happening for the current branches itself, we want to have more productivity, and over and above that, every year 30 to 35 branches will be opened. The logic behind this is the 30 branches opened in a particular year is going to contribute to the expenses of the new branches that is going to be opened in the next year. So that is how we want to grow, and that's why, we are a productivity-oriented organization. So this is how the whole thing will happen. So, and going forward, the expense ratio will be somewhere around 2.7 to 2.75. And this is how this company will be run. So, yeah.
Now, Kunal, just to add to what Bharat said, primarily, our OPEX will continue to be one of the best in the industry. And even if you look at, if you look at significant part of this OPEX, not only for us, for the others also, is really the manpower, related cost. And the manpower cost again has got two elements. One is really the productivity of the manpower, and second is really the attrition, the high manpower cost arising out of the high attrition, particularly at the field sales officer level. So those companies which have got a very, very high attrition level, at the field facing, like customer facing jobs like sales and collection, their, manpower cost tends to be higher. At the same time, those companies where the productivity per staff, number of files per staff is lower, their manpower cost also will be higher. So we are very conscious, hence, into two things. One is that very, very particular about tracking, achieving target setting, achieving training, hand-holding, everything on the, to ensure, decent level of productivity, right up to the branch level, sales officer level, collection officer level, and also very conscious in terms of, about our attrition levels. So the lower attrition and higher productivity is something which is helping us to maintain reasonably well our manpower cost, hence the overall OPEX itself. Of course, there are, so in other words, even for, it's not that we pay lower salary or anything, but our salary when compared to the others, when we get some kind of interfirm comparisons, it's good. But at the same time, our operating cost is lower because of, we are very conscious about the productivity aspects.
Sure. And lastly, in terms of the overall NBFC growth, so quite strong, almost from say 1,500, it's going up to almost like 1,700 odd crores in one single quarter. So would this maybe what's actually driving this kind of a sequential growth, maybe almost like more than 12-13 odd % on a quarter-on-quarter basis, 35 odd % on year-on-year? And would this maybe in terms of the proportion now being there at 21 odd % on the consolidated, given that we need to meet up with the overall home loan as well? So would we see that component going up, and any impact on yields positively that we could see on account of this? Yeah.
If you look at the NBFC growth, as you rightly said, from 1,512 crores to 1,722 crores, what has happened is, right from April onwards, we have started booking some of the LAP purchase and construction, the non-housing loans also in the NBFC, which will yield around 17.5 to 18%, and also the small business loans, which is yielding around 21%. It is basically because of that, these loans were earlier booked in the housing finance company, that we have moved it into the NBFC. That is why the growth is stronger there. So that is one. Then the next thing, you are talking about the yield increase, but it might not be that much because we are booking the non-housing loan, which is earning 17.5 to 18 also in this. So with the result, you might assume that all these loans are earning around 21%, which is not the case. So it might not, to that extent, it might not positively impact on the yield.
Sure. And traction would continue?
Traction will continue, yes.
Okay. Yeah. Thank you.
Thank you. The next question is from the line of Rinesh from ICICI Securities. Please go ahead.
Yeah. Hi, sir. Congrats on a good set of numbers. Just two questions. One on this Tamil Nadu growth, which has been slightly relatively lower as compared to other states.
Yes.
Now, is this due to the competition in Tamil Nadu, or is there something else, at the ground level, wherein we are not growing? Because when we look at the other peers, who are based out of Tamil Nadu, those guys are growing, at a decent pace. So how one should look at it this time?
The thing is, I think in the last quarter and the last to last quarter, we explained that there were some staff issues with us, and that's getting corrected. And of course, in the last quarter, we had told that the whole issue has got corrected, but still the the contribution from the people has to come more faster, but that has not happened in Q3. Over and above that, as I told you, there was some disruption in the last 10 days or 15 days in December, where some of the areas were affected by flood, and because of that, the contribution was not able to come in. In fact, our disbursement growth of, I think we were aiming for 800 crores of disbursement, and because of this flood, this 767 crores came in. So it is basically, if that had come in, I think the disbursement growth also would have been better. But that has been caught up in January, Ramesh. So hopefully things will be back to normal in Tamil Nadu in Q4.
Got it. And second question again, sorry to circling back to the cost of it. But let's say internally when we are targeting 30% growth, and the way, competition is in this segment, do you feel that, adding 30-35 branches would be enough to sustain this kind of a growth rate?
Yeah, actually, to really look at it closely, I think this point I brought it out reasonably well in presentation. So one is really, we are really working very closely, on the inquiry generation, through the other channels, including the customer app, Eco Partners app, and the social media. And I think we have done about 70% of our disbursements through these inquiries. In fact, we have about 1,25,000 customers already, and of that, about 70,000 customers are really already in our customer app. And, and we are expecting that, we would expect at least about 4 to 5 inquiries coming from the friends and relatives of these existing customers per annum, the 4 to 5 inquiries per annum. And that itself will be running about 300,000-400,000 inquiries. That inquiries really flowing in a particular, spot, and we are really going through the inquiries and cold calls are really converted to warm leads after going through the customer background requirements, loan, etc., and then forward to the branch. Because of them, our hit rate is becoming very good and very high. And sales office also, when they go and meet 10 customers earlier, the hit rate may be 2-3. But today, the hit rate has really substantially improved. So that motivates sales guys also to spend more time on the field to look at new customers. So in other words, this is a new, this is something which we've been working in the last 6 months, now started fructifying. And this will complement our existing branches. So branch alone is not the way for us to, way to grow. Branches will be there, we'll keep adding. But same time, we're also working on all the other channels as well.
Got it. So, sir, if you can share, some numbers to this. So, let's say in Q3 of incremental logins, how much of the incremental logins would have come from the non-branch channel?
I'll just explain. Of the total, I'll talk in terms of disbursements instead of login. Out of total disbursements, 7.41% came in customer referrals, 6.21 came in construction ecosystem app, 3.17 came through social media, which adds up to almost 16.8 or something.
Yeah. Got it.
That's what we are telling. 17% of our disbursements have been through these channels.
And do we have any internal cap on, let's say, sourcing from alternate channel, let's say 25, 30, or at what percentage you will again start?
See, what is happening, if you do the sourcing through this thing, still the branches are involved. It is not that branches are excluded from this. See, the leads are getting forwarded to the branches. The branch people have to do the work of having a discussion with the customer, assessing his cash flows and everything. So still that is there. So, there is no cap. And also the conversion rate here are, once the login is happening, the 90% of the logins are getting sanctioned, which means it's a real good channel to be in and then taking it forward.
Got it. Thank you and best of luck, sir.
Thanks, Ganesh.
Thank you. The next question is from the line of Shubhranshu Mishra from Phillip Capital. Please go ahead.
So, what is the curing rate from bucket 1 to bucket 0? That's the first question. Second is, what are these quasi-home loans in the home loan book? And the third one is, we mentioned that we invoke SARFAESI, but if my understanding is correct, SARFAESI can't be invoked below ticket sizes of 20 lakhs. So, if you can speak on these three, sir. Thanks.
Yeah. First, let me talk about this SARFAESI. In the case of housing finance company, sir, there is no limit on invoking this SARFAESI. Even if it is 1 lakh or 2 lakhs, in the case of housing finance company, SARFAESI can be invoked. And that is the first thing. Next one is on the, what is that? The second question, what was that? Bucket 1 to... Sorry.
The net shifting rates from bucket 1 to bucket 0.
What bucket? What is it? You mean the receivables? Yes, sir.
No, sir. So we've got, you said that the 1 plus is 8%. So how much of that is getting cured? There would be some kind of curing as well, right?
Curing to the nil OD. That means from one bucket it is going to the nil OD, is it?
It's going back, sir. So there would be a flow forward rate and there would be a backward rate.
Collected and are outstanding. There's nothing like rolled back, no? Either we collected or it remains outstanding and moves into the...
No, it has almost, see, what has happened is over the quarter it has remained stable. What is 8.1 is the, last time it was around 8%. And if you look at the 60 to 90, it was around 0.5 or 0.68%. So it has remained at the same level. Yeah.
Okay. Got it. And quasi-home loans?
Quasi-home loans, what has happened, see, we are in the business of funding with self-employed people. So they don't plan well in advance to get a housing loan. So if a loan given has to be... If a loan given has to be classified as a housing loan, the customer should approach us when the construction is happening. Since we are in this business of funding the self-employed people, unlike salaried people, they get bulk cash flows from business and they use that money for construction of the house, complete the house, and they live in that house. So once they start living in the house and then when they are continuing with their businesses, they find themselves cash short for running the business. So they come to us for a loan, but that cannot be classified as a housing loan as per the NHB direction. So we give it as a quasi home loan, and but the time period is 3 to 6 months of completion of construction. When they come to us, it gets classified as the quasi home loan. Otherwise, if it is more than 1 year or 2 years, it gets classified as a small business loan. That's the difference.
So is it an unsecured loan or a secured loan? What is this exposure?
There is no unsecured loans in our portfolio. Everything is secured by immovable property.
Self-occupied
residential immovable property.
Thank you. I'll come back in the queue, sir.
Thank you. The next question is from the line of Arul Selvan from Independent Advisor Private Limited. Please go ahead, sir.
Sir, can you hear me?
Yes.
Okay. Just wanted to go back to a previous comment that was made. Did I hear you correctly when you said that you're planning on moving your overall liabilities towards having a greater proportion of variable borrowing from fixed borrowings currently?
Yeah. Yes.
Okay. No, because I'm just asking you to understand, do you have any specific target in mind in terms of where we want our fixed costs or fixed versus variable borrowings to be at?
Where is the borrowings to be at? It will be around 40-60.
And 40% is the fixed cost?
Yes.
Okay. So the reason why I'm asking here was that, given that your asset book has, 80% of its, assets in fixed cost, I was just trying to understand what was the reasoning or what was the thinking behind shifting towards a more higher proportion of variable cost, because I would think that given the higher proportion of fixed assets, it would be perhaps more prudent to have higher proportion of fixed borrowings as well.
No, see, if you look at it now, because of this interest rate environment which is going to come down expectedly, so we are moving into this. If you look at our past experience, we were able to get around 60 to 65% of our loan borrowings in the fixed rate form. In fact, all of our NHB borrowings is fixed rates. So we will be able to, because of this interest rate scenario, we are getting into this, but we are very confident that we will be able to move over to the fixed rate borrowings in the future as well.
Okay. Perfect. That sounds good. So it's just the current interest rate environment which is kind of making you slightly shift your borrowing structure.
Yeah.
Okay, that's one question. The second question I wanted to ask you, I didn't hear the previous question on this. The growth rates in Tamil Nadu, were they affected predominantly because of the staffing and the floods, or were there any other issues, affecting the
issues. As I explained, the staff issue has been sorted out. It is basically the floods in December that has affected the growth in this quarter. That has come back to normalcy in January. So this quarter it will be back.
Right, sir. And has there been any impact on the collections? In Tamil Nadu specifically?
Very marginally, yeah.
Very much. Sir, could you please give a number if you had to give a ballpark estimate?
Collection efficiency, it was 99.72 earlier. That has become 99.65. Yeah, right.
Okay. Excellent, sir. That's it from my side. Thank you.
Thank you. The next question is from the line of Nishit Chawati from Kotak Institutional Equities. Please go ahead.
Hi, thanks. Just two clarifications. One was, you mentioned that your incremental cost of borrowing went up 10 basis points quarter-on-quarter.
Yeah. Thank you.
On an ex-NHB basis.
What is that? I didn't hear you properly.
Including NHB borrowings. I'm saying when you...
We have not drawn the NHB borrowings which has been sanctioned, which is around 300 crores. We'll be drawing it in February.
Sure. And, if I look at the fee income, I know the numbers are small, but there was some uptick, on a sequential basis.
Yeah.
Anything to read in that?
No, it is basically we have just realigned some of the processing fees. That's it.
I mean, the insurance part, is it?
Not the insurance part. It is basically the processing fees which we charge to the customers. We have just realigned some of it. That's it.
Okay. So then it kind of gets adjusted maybe from the yield to fees or something like that.
Yeah.
Okay. That's verified. Thank you.
Thanks.
Thank you. And the next question is from the line of Ankit Bansal from AB Investor. Please go ahead.
Hello, sir.
Yes, Ankit.
My question is, sir, the kind of environment coming ahead in next 2 quarters with the rate cut, evidently. Sir, with the kind of rating you have from the rating agencies, one of the best. Sir, are we able to see the best phase of Aptus growing more than 20%, 30%? Can you please share the details?
As we have been guiding the market, the loan book growth, we have been guiding between 25 to 30% in the next 3 to 4 years. That will be done.
Okay. But sir, I want to know the kind of environment we are getting, like with the rate cuts. I want to see the aggressive side of the Aptus about the growth, because you are stable in this kind of environment with the rate cuts in your hand and with the kind of interest rate ratings from the agencies of borrowing you have. The growth, I want to know how aggressive can you on the growth side, so that will be beneficial.
It's a bit too early to really comment on that because we don't know what is the kind of reduction in interest rate going to happen and over what period of time, and whether it is substantial enough to influence a customer to take a call on home loan demand. There are still a lot of things around it, so we possibly would be able to comment better as we go forward than today.
Okay. Yes. Sir, are the next question is, are the net NPs and gross NPs kind of will remain in that range or upside 1 or 2 bits?
Currently, the net gross NPA is at 1.19 and the net NPA is at 0.89. Our endeavor is to bring it around 1.05 to 1.1. Then that will get maintained. So that's what will be the NPA.
Sir, any new geography are you entering in Delhi side or in north side?
No, our growth strategy has always been a contiguous growth. So we have opened branches in Odisha and Maharashtra. In November, our first branch in Maharashtra has happened, and we would like to fully use the potential that is available in these 2 states, and then get into the next stage, which is near Maharashtra, and then it will go to the north. But as of now, it will be a contiguous growth, which is from the current existing states where we are operating.
Sir, next is, are you seeing
sorry
the
to interrupt, sir. May I request you to follow back the queue, like several participants are waiting.
Okay, sir. Okay.
And the next question is from the line of Bhavya Sanghi from Fortress Group. Please go ahead.
Thank you for the opportunity, sir. Can you hear me?
Yeah.
So my question is a little medium term. So as in the earlier participant question, you alluded to a OPEX to asset ratio of close to 2.7 to 2.75. So my question is with respect to the capacity additions and branch expansion that you are going through, and I'm sure the 25 to 30% growth guidance would entail higher number of accounts getting added and more leads from non-Aptus markers like except from feet of street, the other avenues that you are looking at like social media, etc. So I was just wondering and wanted to ask your opinion about the IT systems and the investments that you would entail in the medium term. Is the management thinking about enhancing the LMS, LOS, and the investments that could happen in the future when the loan book size grows above 10,000? Thank you.
Sure. See, what is happening, if you look at our IT investments, if you look at the operations of the housing finance company, whether it is sourcing, credit, legal, technical, collections, everything we have a technology-enabled kind of a thing. And then we have also got Novak systems, which has been in operation from 2016. It is an end-to-end system. This is one thing which is happening now. We are having various apps for sourcing the customer, for onboarding the customer. We have a credit score card mechanism for evaluating the customer. And also we have the app which captures the video of the customer at his workplace, at his residence, and then we will be able to assess them. And similarly, in the technical, we have an app which marks the boundary, which geotags the property. Similarly, the collections, we have an app which monitors the movement of our collection officers. It optimizes its route to go and collect the money. All these things are there. Over and above that, what we are doing now is we are changing the loan origination system with the lead management system, and this will be a mobile-first technology where people will be able to onboard the customer using a mobile, and that is from the main system, which is Novak, which is being supplied by the Novak system itself. So this is one investment which we'll be making, and whatever is relevant and what is, if you look at our legal, what has happened is we have tied up with the service provider called Legality, where all the agreements are done digitally. All the agreements are signed digitally. So these kind of enhancements and also the use of technology will be investing in, and then what is relevant for the housing finance industry in the affordable housing will be investing.
Got it, sir. Thanks for the elaborate answer. Also wanted to, ask you about any plans that you guys have in the medium term in the NBFC arm to do small, like a lower tenure loans, like a consumer loans. And will the IT system, if yes, will the IT system be unable to, do those in future? Thank you so much.
No, we don't have any other intention other than to do these three products which we are in now.
Okay, sir. Thank you so much.
Thank you. The next question is from the line of Raghav Kar from Ambit Capital Private Limited. Please go ahead.
Hi. Thanks for the opportunity again. To one of the questions, you were highlighting that the employee attrition issues that you were facing 1 or 2 quarters ago, you addressed those issues. So can you elaborate on what specific measures have you taken, and how confident are you that given the increasing competition in affordable housing space, these employee attrition issues won't crop up again? Thanks. That's all from my side.
Obviously, one can't take the view that the attrition will never happen or will not happen. But what we are trying to do is that, in fact, even when we had this attrition issue in Tamil Nadu, but overall terms, the company has grown the loan book by about 28%. And there is a very strong growth in Andhra Pradesh and Telangana and Karnataka, in that order. And Tamil Nadu also grown by about 13% or so in the loan book. And the overall company terms, we've been growing. So in particular pockets, yes, in Tamil Nadu, we had that we have resolved. But to answer your question in terms of what action we are taking to reduce attrition is really in terms of we are taking lot more care at the recruitment stage and at the training, and also in terms of handholding them, the new staff, as will be put along with the existing experienced sales officer or with the branch manager himself to handhold him and go along with him for 2-3 months for all the transactions. So that helps the new sales officer to get inducted properly into the system. That we are doing. Also, what we have tried to do is that to encourage, because we also saw based on data that the attrition, if at all, is very high in the early part of the game. The attrition is highest in the first 6 months, first 1 year. But once the 1 year, 2 year process, when they come to know probably the company becomes know of them and the attrition rate drops. But the challenge is really how do we really hold them in the first 6 months and the first 6 months, 7 months. And that's where we have even introduced a sort of recognition scheme that those guys who complete the first 6 months well, we will reward them with a particular reward scheme. So, that way we are really taking several initiatives, particularly for the field-facing, customer-facing jobs like sales officers and collection officers, right from the recruitment to induction to handholding to motivation measures, we are trying to reduce attrition.
Sir, what kind of rewards are you referring to? Can you give us some specific examples? And one more question is, in your organization hierarchy, from which level do you start issuing stock options? Just to understand.
Sorry, I think we would like to take it offline because we don't want to get into specific reward schemes and numbers and financial aspects. Yeah. We can give them, it's not an issue, but otherwise speak to you later. We'll see what we can get. Yeah. Hello?
Thank you. As that was the last question, I would now like to hand the conference over to management for closing comments.
Yeah. Thank you, Mona, at least for organizing this conference call. I would like to pay my sincere gratitude to all analysts and investor friends who have taken time out of their busy schedule to listen to us today. Please feel free to connect with us in case you have any further queries. We would be happy to get back to you. Thank you.
Thank you. On behalf of Dolat Capital, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.